All right, I'm about to show you 10 first-time homebuyer mistakes that cost people thousands of dollars, and I see them happen every single day. I'm Weldon Hobbs. I'm a real estate strategist based out of Colorado Springs, but I help people across the country make better decisions when we look at life, wealth, and real estate and how all those things work together. I connect you with a like-minded individual to make sure that you make the best decisions in your real estate purchases. Now, in the past month alone, I have watched 3 deals fall apart because of preventable mistakes. One buyer, they lost their earnest money. Another one, they discovered $30,000 in foundation problems after closing. And then a third, they got their loan denied because what did they do of all things? They went and financed furniture before closing. Now, these aren't rare situations, what I'm describing. These happen constantly across the country every day. And the worst part, every single one is avoidable. So today, I'm going to walk you through the 10 mistakes that I see first-time homebuyers make. Real examples, real costs, and exactly how to avoid them. So let's get into it with mistake number 1. And that's getting pre-qualified instead of pre-approved. Those two terms, they sound the same, but they are not. Pre-qualification is a quick estimate based on information that you provide. No verification, no underwriter review. It's basically a guess. Now, pre-approval though, and this is important, that means a lender actually pulled your credit, verified your income, reviewed your assets, and an underwriter looked at your file as well. And that's not required in every state. Just know that it's a more intensive process. Here's what happens when you confuse the two. Young couple comes to me. They're pre-qualified for $350,000. We find their dream home, make an offer, seller accepts, and then 3 weeks into the escrow, meaning after the offer's been accepted, the lender actually reviews their file. It turns out they had too much debt. They only qualify for $310,000 and the deal falls through. They lose their $3,500 in earnest money, and the house they love, that goes to another buyer. Now, frankly, that depends on the state that you live in and what the contract to buy and sell looks like. In Colorado, it's actually very friendly, but that's not the way it is across the country. Either way, you need to be aware of what you can actually afford, and the pre-approval is 1,000 times better than pre-qualified. In fact, I won't even take somebody around unless they are pre-approved. If a deal falls apart, they're going to be emotionally devastated, all because they didn't get a full pre-approval before starting the search. Here's the fix. Before you look at a single house, get pre-approved, not pre-qualified. I'm going to say that again. Pre-approved with full underwriting review or whatever is required by your state. Your lender, they might call this underwritten pre-approval or verified pre-approval, but make sure they actually pull your credit report, verify your income with pay stubs or tax returns, and they check your bank statements. This can take a few days. Here in Colorado, the lender I use, it is within a few hours that he can get it done from A to Z. Going this route, it saves you from heartbreak. Mistake number 2, shopping at the top of your budget. When you do that, the lender approves you for $400,000. So you start looking at $400,000 homes. In fact, 410, 420, because you think maybe I can negotiate this down. We'd never do that, right? Of course we would. But here's the problem. Lenders calculate your maximum approval, not your comfortable payment. I watched a family, they got pre-approved for $390,000. They bought a house for $385,000. Now, technically within their budget, but 6 months later, they were stressed. Know that your real estate agent, they can't tell you what to do. You're pre-qualified for it, but they can advise you that you might not enjoy life as much. But folks, they do what they want to do, which is fine. But 6 months later, they're stressed. They can't afford to go out to dinner. They can't save for emergencies. Their kids, they need braces and they don't have the money. They're house poor and they regret the purchase. The mortgage payment isn't the only cost of home ownership. You've got maintenance, you have utilities, homeowner association fees if those are applicable, property tax increases, homeowner insurance increases, repairs, and just life. Now, stop me if you've heard this one before. Kids need things. Cars break down. Medical bills. They are going to happen. If you max out your budget on your house, you have zero cushion for life. But there is a fix, and what I would recommend is to shop 10 to 15% below your maximum approval. Or another way to look at it is don't spend more than 28% of your gross income when you calculate both the mortgage, taxes, insurance, and actually budgeting for maintenance as well and homeowner association. Yes, you're going to get less house, but you'll actually be able to enjoy living in it. You're going to have more money for repairs, emergencies, life, and you're not going to be stressed out about money every single month. Buy a house that you can actually afford comfortably, not a house that you can barely afford. You're setting yourself up for failure and some heartaches. Mistake number 3, skipping the home inspection. This one kills me. A home inspection, it costs anywhere from $300 to $700 usually. And I see people try and skip it to save money. Not on my watch. I'm not going to let that happen. We're going to get the home inspection because I won't be able to sleep at night knowing that you are setting yourself up for potential significant bills down the road. You're not doing it to save money because it's actually going to end up costing you money. And you think you might be making your offer more competitive. That's not it at all. Here's an example. The buyer, they found the house. They loved it. It was $450,000. It's a competitive price point. They listened to their uncle versus their real estate agent. Hey, waive the inspection to make the offer stronger. What did they do? They did it. They listened to their uncle. They closed on the house. 3 months later, they noticed cracks in the foundation. Think that's an issue? I would think so. They call a structural engineer, and $18,000 in foundation repairs were needed. Plus, there was another $5,000 in drainage work to prevent it from getting worse. That $500 inspection would have caught this. They could have negotiated with the seller, or they could have walked away entirely and just found a different house. Instead, they got stuck with $23,000 in repairs on a house that they just bought. Now, here's the thing. This also happens with new construction. So don't be fooled. Just because it's new means it's in perfect condition, because that's not the case. Think about the city home inspectors. Think they have time to actually inspect every nook and cranny of that house? No way. They don't. So people think new homes, they don't need inspections. You couldn't be further from the truth in this, okay? New homes, they have problems all the time. Missed electrical issues, plumbing installed incorrectly, HVAC problems. I've seen it over and over. Here's the fix. Always get a home inspection. Now, the builders, they don't like the inspectors to come in ahead of time. And in fact, it can be hard to get an inspector to come in ahead of time. But usually there's a warranty with things. If you can't get them in before you close, get them in right after, and that will help inform your punch list, even if the market is competitive. Know that there are other ways to make your offer stronger without waiving your inspection. Offer more money is one way. Offer a faster closing is another. Offer to cover some of the seller's closing costs, again, if it's super competitive. The market that we're in here in the West, or if you're in the South, Southeast, not really required in 2025, 2026. But here's the deal. Keep your inspection contingency. It's your safety net. Don't throw it away. This is what's going to let you know what you're getting into before you get into it. Mistake number 4, not understanding the closing costs. This is the mistake that almost kills deals at the last minute. Picture this, first-time home buyer, $20,000 for the down payment. You are proud. You've dedicated yourself, set the money aside, reached a goal, and you have worked hard to make this happen. You are ready. You find a house that's $300,000, put $15,000 down, 5%, right? Everything looks good. Then 3 days before closing, you get the final closing disclosure, $12,000 in closing costs. You don't have an extra $12,000. You used your savings for the down payment. Now you're scrambling. You're calling family, trying to get gifts, panicking in some cases. The deal almost falls through. And here's what people don't understand is that closing costs are separate from the down payment itself. Closing costs typically run 3 to 5% of the purchase price, and that's more if you have a loan. So on a $300,000 home, that's $9,000 to $15,000. These costs, they're going to include lender fees, title insurance, escrow fees, property taxes, homeowners insurance, homeowner association transfer fees, if those are applicable. You need to have or plan for to have the cash for both the down payment and the closing costs. Here's the fix though. From day one, budget for those closing costs. If you're buying that $300,000 home, assume that you need $15,000 for down payment plus another $12,000 for the closing costs. That's $27,000 total. Ask your lender for a loan estimate early in the process. That's going to show you the estimated closing costs. Now, your real estate agent should also be advising you to look these things up, to coordinate with your lender, to make sure that you are prepared for it and you plan accordingly. If you don't have enough for both, ask about seller concessions. If you have a real estate agent worth their salt, they're going to be able to assess the market and ask for those concessions if the market will bear it, right? Sometimes sellers, they're going to agree to pay some of your closing costs as part of the negotiation. I found that over 2025 and 2024, we asked for closing costs every time, but you have to ask more than 3 days before closing. Mistake number 5. This is falling in love with the first home that you see. It is a psychological trap. And if you're a first-time home buyer, I understand it, I get it, but don't do it. You've been dreaming about home ownership. You see your first house. It's cute. It's beautiful. It's wonderful. It has the kitchen that you imagined. The backyard, it is perfect. Like I see it in my head right now. You fall in love, you make an emotional offer, but you overpay. I watched this happen this last summer. We averted it, but this is what happened. First-time home buyers. They walked into the house. They said, "This is the one, Weldon. This is the one that we want." And I said, "Okay, great. This is fantastic. I'm glad we went and saw some homes. Glad you like this one. Let me go back and do my homework and make sure that we're not overpaying." Guess what? The sellers had priced that home $40,000 above what the neighborhood rate was. And why was that? When you look back to when they bought it in 2022, they were just trying to cover their costs. They bought at the peak of the market. And now they were just trying to pawn that off onto somebody else. Not with me. That's not going to work. We do our homework. And if you find yourself in that situation, call me. I will find you an agent in your local area that has the same values that will look out for you and make sure that you're not overpaying. They were willing to offer $40,000 above cost without any comparison, without any look, but we stopped it. It was pure emotion. They wanted to win the offer, but had they done that, they would have found themselves 6 months later having overpaid by that amount, because they didn't have any context. Make sure you have the right representation for you. Now, why and how do we avoid this? We need to tour at least 10 houses before making any offers. I know that sounds like a lot, but you need context. You need to know what your money actually gets you, because you're going to figure that out really quickly. You're going to find out different parts of the city, different types of homes, age, different systems. And after you've seen those 10 houses, you're going to have a much better sense of value. You're going to know when you're looking at a great deal versus an overpriced property, and you're going to make smarter offers. Plus, touring multiple homes is going to help you clarify what you actually want versus what you think that you want. There's going to be some change and evolution. So the things that you thought were non-negotiable, they might not matter after you've seen a few options. I encourage you to shop around. Get context, then make your offer. Mistake number 6, and that is waiving contingencies. When the market gets competitive, people start waiving contingencies, and I don't recommend it because this is one of the largest assets in your portfolio, so you want to make sure that you are buying right up front. So the inspection contingency, appraisal contingency, financing contingency, even the condition that they can actually get a loan. Look, they waive everything to make their offer look cleaner. Again, your real estate agent can't stop you from doing these things, but they should be advising you to not do these things. Here's what happened to a military family that I recently heard from. It was a hot market, multiple offers on every house. They find a great property, $320,000 in their market. 6 other offers were there too, and their agent tells them to waive the inspection contingency to be competitive. They do it. They win. They close. 2 months later, they smell something weird in the basement. Smells are terrible. They investigate it, and what is it? It's mold. $25,000 in remediation, plus they have to disclose it if they ever sell. That tanks the value. That inspection contingency that they waived, it would have caught it. They could have negotiated with the seller to fix it before the closing, or they could have walked away and found a different house altogether. But now they're stuck with a $25,000 problem and potential health risks and issues for the kids as well. It's not a great situation. But here's the fix. Don't waive your contingencies ever, especially the inspection one. You certainly don't want to waive the loan one either. Just don't do it. And if you do, make sure you know you're making a fully informed decision. I don't care how competitive the market is. There are other ways to make your offer. Do you see a theme here? Offer more money if you can afford it. Offer a faster closing timeline. Offer to let the seller rent back for a few weeks after closing. Think creatively. Write a personal letter explaining why you love the house. Offer to cover some of the closing costs, but keep your inspection contingency. It's what protects you from buying a money pit. Your home, it's likely the biggest purchase of your life. Like I said, don't skip the safety check. It's there to protect you. All right. Whew. Mistake number 7, not hiring your own agent, or hiring the wrong one, really. So I see this a lot at open houses. Buyers, they walk into an open house. They love the property. The listing agent is right there. Friendly, helpful, clean, brave, reverent. Boy Scouts. The listing agent says, I can help you write an offer. And since I'm already representing the seller, the deal, it's going to be smoother. The buyer thinks, great, I'll save money and it'll be easier. Wrong. Here's the problem. The listing agent works for the seller. Their legal obligation is to get the seller the best possible deal. They have a fiduciary responsibility to them, not you. Now, they might be nice to you, but their loyalty is to the seller. In Colorado, what we have is called a transaction broker. But at the end of the day, they know way more about what's going on with the house on the seller side than they do for you. I watched a first-time home buyer work with a listing agent. The house was listed at $295,000. The buyer offered $295,000, right on the dot. The listing agent accepted immediately. No negotiation, no inspection negotiations, no asking for repairs, nothing. The buyer later found out that the seller would have accepted $280,000. And there were $8,000 in deferred maintenance that the listing agent knew about but didn't disclose. Look, that buyer left $15,000 on the table because they didn't have their own representation. Here's the fix. Hire your own buyer's agent. In most states, the seller still pays the commission for both agents. It's not required by any stretch. It is a negotiation. If I'm a buyer or representing a buyer, I'm putting that into the deal to ask for the sellers to pay for it, at least out here in the West and certainly in the South right now. So as a buyer, upfront, ask your agent, what is the market allowing for right now? So that way, you know if it's going to cost you anything or not. But more times than not, your agent is going to save you some money and negotiate on your behalf, because your agent, they work for you. They negotiate for you. They protect your interests. And make sure you hire an experienced agent who knows your market. I study the market every single day because it matters to me that much that I know what's going on and how to set my clients up for success whenever they're buying or selling. Know that if you need representation, call me. I will find you one in that market, so that way you are set up for success. And I know that they share the same values and perspective that I do, and they can take care of you. Don't hire your cousin who just got their license, not someone who does real estate part-time. And if you do, make sure you ask them the right questions, so that way you know that they have your back. They know what they're doing. And if you need those questions, call me and let's talk about it. So a full-time professional, though, with a track record is always the best case. Ask how many transactions that they've closed. Ask what kind of experience they have. Ask for references. Ask about their experience with first-time home buyers. Your agent is your advocate. Mistake number 8, ignoring the neighborhood and your future plans. People fall in love with the house. They forget about the neighborhood and they don't think about where they're going to be in 5 years. This is where my 5-year rule comes in. If you're not planning on owning that home for at least 5 years, you probably shouldn't buy. It doesn't mean you have to live there for 5 years, because you can live in it for 3 and then rent it out for a couple of years if that's within your risk tolerance. But buying a home, it's expensive, and selling a home is expensive. You have closing costs, agent commissions, moving costs. If you sell in less than 5 years, you're often going to lose money. But here's the other side of it again. Even if you're staying 5 years, you need to think about the neighborhood. A couple who bought a beautiful home, perfect layout, great price, but it was in a school district that was declining. 3 years later, they got a job offer in another state. Fantastic opportunity for them. They tried to sell their house and it sat on the market for 6 months. Families with kids didn't want to move to that school district. They finally sold it at a $15,000 loss, and that was just on the retail price. They then had to account for the fees to sell. If they had researched the neighborhood better, they would have known. Again, you should be informed by your agent. Not that they can tell you what to do, but they can inform you on what's going on. Declining schools, rising crime, no new development in that area, those are all red flags. Here's the fix. Research the neighborhood just as much as you research the house. Look at school ratings, even if you don't have kids, because that affects resale value. Check the crime statistics. That's another great thing. Go to the local city site. Drive through the areas at different times of the day. Recently had a buyer who did this, and I loved it because I knew that, again, they were making informed decisions. They even talked to the neighbors. Great tip there. Look at future development plans for the area. Are new businesses coming in? Is the area growing or is it declining? Apply the 5-year rule with that lens. If you might move less than 5 years, seriously consider renting it out. I can walk you through steps that we use to manage our properties that might help you out. Or buy in an area with a strong resale potential. Think long-term. Mistake number 9, making major financial changes during escrow. This goes back to the furniture example from earlier. This breaks my heart the most because it happens so close to the finish line. You get your loan approval, you're in escrow, you're 3 weeks from closing, you're excited, you start thinking about furniture, you finance a new couch, open a new store credit account, or maybe you just buy a new car because you're proud to be a homeowner. You think, I'm already pre-approved, it's fine. Guess what? It's not. Your lender pulls your credit again right before closing. They see the new debt. Your debt to income ratio will change and your loan gets denied the day before closing. Avoidable for sure. Again, get the right representation up front. Your lender should be telling you about that as well. Here's the fix though. Change nothing financially from the time that you get your pre-approval letter until after you close. Don't open new credit cards. Don't finance new furniture. Don't buy a car. Don't make large cash deposits without documentation. Don't switch jobs if you can avoid it. And don't even pay off collections without talking to your lender first, because sometimes that can backfire and you can let them explain it. Your lender, they're monitoring your financial situation throughout the entire process. You want to reduce those variables that can change or affect your approval. So keep everything stable until you have the keys in your hand. Then you can buy whatever you want. Mistake number 10, not planning for ongoing costs. First-time home buyers, they calculate the mortgage payment. Easy, slam dunk. Maybe they even remember property taxes or insurance, because a lot of times that's rolled into the payment every month anyways. But they forget everything else. 6 months after closing, they're financially stressed. Here's what people forget. Maintenance and repairs. Make sure to set some money aside every month for that. Your home is going to need repairs. It's part of home ownership. The rule of thumb is 1% of your home's value per year. And on a $300,000 home, that's $3,000 per year. So that's $250 per month that you should be setting aside. Water heaters die. HVAC systems fail. Roofs need replacing. Appliances break. It's not if these things will happen, it is when they will happen. Then there's the utilities. So when you're renting, sometimes utilities are included or they're lower because you're in a smaller space. When you buy your house, your utility bills, they go up, especially if you're buying a larger home. Homeowner association fees, if your neighborhood has one, these are mandatory and they often increase every year. Then you have property tax increases. Property taxes aren't fixed by any stretch. They go up over time. And homeowners insurance, that definitely increases as well. I've seen insurance premiums double in some areas over the past few years. All of these costs, they just add up. You're going to need a new roof eventually. Set that money aside. In fact, I really don't think that you should buy a home unless you have some money set aside in a bank account already, because things are going to happen. Murphy will happen. So when you add everything up, that's your real monthly housing costs. If that number stresses you out, you're looking at houses that are too expensive. Buy less home. Go back and shop in a lower price range. It's better to buy less house and be comfortable than to buy more house and be stressed. We talked about a lot. Those are 10 mistakes. Let me recap them. 1, get pre-approved, not pre-qualified. 2, shop below your max budget. 3, never skip the inspection. 4, budget for closing costs separately from your down payment. 5, see at least 10 houses before making an offer. 6, don't waive your inspection contingency or contingencies in general. 7, hire your own buyer's agent. 8, research the neighborhood and apply the 5-year rule. 9, make 0 financial changes during escrow. And then 10, budget for ongoing costs beyond the mortgage. Every one of those mistakes, it's avoidable. It's going to make your life happier, more comfortable. Every one of them costs you money if you don't plan for it. I see it happen constantly. Don't let it happen to you. If you're getting ready to buy your first home and you want guidance from someone who's seen these mistakes over and over, book a free 30-minute clarity call. Looking in the caption below, you're going to see my Calendly link. Let's talk about your situation, your timeline, your budget. I will sync you up with the right agent to help you out in your situation. You can also call or text me directly. Thanks for watching, and if this video was helpful, hit that like and subscribe button for more real estate content for first-time home buyers, military families, families in general, people in general, because we talk about scenarios through the lenses of life. We all have goals. They're going to be different from person to person, family to family. Wealth, how do we optimize that situation? And then 3, that's when the real estate comes. Thanks for listening. Have a good one.